get left at this turn, and then at this hallway, that's where the gap is. We also have a water up here, that hole. And so, thanks. Thanks all for being here. I'm Terrence. I'm the director of C-City. With the WTIA, C-City is all about community, bringing folks in our tech ecosystem together to grow our innovation economy. Seattle is a tech hub, and we think that it's one of the best tech hubs in the nation, but it's the best because of the folks who are part of it, the workers, and the entrepreneurs, and folks who are doing the work across the tech center, across the tech ecosystem. And in order to do that work well, community is a really important part of that. And so how can we connect folks to grow together and keep people in the region? There are a lot of choices that you might have. Why Seattle or the Puget Sound region for Washington State, there's a lot of great reasons why, and community should be one of them. So that's what this is all about. Techcelerate is our newer initiative, and we're going to be having another one in June. So stay on the lookout for that. And it's going to be about this. How can you might be early in your journey, your startup journey, or venture capital journey, or entrepreneurship journey, or you might not, maybe you haven't made that step yet. That's something that more people should consider. And so we're here to help you understand that that's a possibility, that's a reality, it's not far-fetched. And there's some folks who've done it, and you're gonna hear from them. So we're gonna get started with, if the panelists can come up to the front. Or how did you want to do that?
I'm gonna go ahead and give like a lead in on like venture, and it'll be a fairly lengthy one. Does this actually work? Hello? A little bit.
Yeah,
okay, good. And so I have a spare mic here so that people on the call, if we have Q&A, so I'll leave this just here for when we get to that part. Okay. Grab my little slide advancer here. So welcome, everybody. Thank you for taking a bit of this lovely day out to spend some time with us. As Terrence introduced, well, he's with C-City, which is a subdivision of the Washington State Technology Industry Alliance, and I work with Venture Black. I'm the executive director of Venture Black. And so we are the largest professional association for Black venture scale founders and funders in the Pacific Northwest. We do angel investment through an angel syndicate, and we'll talk a little bit more about that. And we're generally a good place for founders that are working on the next Amazon or Microsoft or Square to get peer support, get connected to different relationships with people that could be funders, people that could be mentors, people that could be customers, so that not everybody has to go and find the same relationships from scratch. That's the basic premise. So today we will be doing an intro to venture, and that's what we'll be talking on. We'll do our panel, and then I'll lay out some closing remarks, and then we'll all get on out of this place so we can enjoy some sunshine. So a little bit about myself. So I'm the executive director of Venture Black. I'm also a managing partner at Greeenwood Ventures. So I founded this as a pre-seed stage, which we'll talk about what does pre-seed stage mean, venture capital firm to direct more investment to Black and brown, generally underrepresented founders. I'm a computer engineer by trade, so I worked at Fluke up in Everett near where Boeing's at, Cisco, and then most recently at Africatown Community Land Trust, which has a history of development going back 3 generations of my family in the Central District. So this thing flaking out, is it hard? So it's okay, I can get rid of it. You guys can all hear me, yeah?
Yeah.
Yeah.
Okay. So, okay, we'll just have this here. So, so how did I get into being in the investment space or being interested in getting access to capital to founders? So I joined the Seattle Angel Conference through some of my work with Africatown Community Land Trust. I came from Silicon Valley to Africatown after spending about a decade down in the Bay doing software development, specifically because I wanted to develop an economic engine for the Black diaspora in the region to make sure that we were doing meaningful progress towards closing the racial wealth gap. And so sat in with the Seattle Angel Conference and then decided I wanted to make one specifically to advantage Black founders and on-ramp new Black angel investors. Currently, Black angel investors are only 1% of angel investors, and Black founders only get 0.4% of pre-seed stage funding, so very low numbers. Then I joined an institution called Black VC and went through their 7th cohort of Black Venture Institute, and also VC Labs, which is minting something like 40% of all emerging fund managers globally. So people that were in my cohort were like in Africa, in Europe, different things like this. So my degrees come from Gonzaga University, computer engineering and electrical engineering, and then Masters of Science in Computer Science from Seattle University here. So founded a VC firm, and mostly we're focused on connecting, empowering, and supporting Black and ally founders and investors of all experience levels. So new angel investors, people that have been long in community but haven't been able to access underrepresented founders as much as they'd like. And we'll talk about this, but my passion for this sort of economic justice is rooted in the work of my grandfather, who is co-founder of Liberty Bank, which was, I think, the second Black-owned bank west of the Mississippi here in the Central District of Seattle, which we'll get into some coverage of what that's about. So our mission, as I mentioned, is to connect, empower, and support the Black venture community by fostering relationships, sharing knowledge, and creating opportunities that are vital for thriving here. And then all of that goes towards creating a world where every ethnicity and gender is equitably represented in building, influencing, and benefiting from the startup ecosystem. And so those might just be words. And so the rest of this precursor talk will be about kind of all of that in context. And so I want to thank our sponsors, so WTIA, thank you very much. And then also the Washington State Micro Enterprise Association. So when I talk about the venture ecosystem, what do I mean? So the innovation ecosystem being all the people that are out there doing research at the universities or independently at their kind of home labs, whether it's in their craft rooms, cooktops, or on their computers, or in some data center somewhere. So all the people that are creating that intellectual property, you know, they need to learn how to license it, and all this stuff isn't so readily taught in most schools. So we have all these side conversations and different professional support people that want to help. And so at that same layer, we need people to be learning about, you know, how to actually create commercial applications out of research and different things like this, and then develop business plans and, you know, get supported. So at the bottom of this innovation funnel, or sorry, at the top of this innovation funnel, we take ideas, people, entrepreneurs, support organizations, and glue infrastructure to get people talking to each other and transactions moving. And we move them further to where we're sharing information, education, and networking, like an event just like this one. And then we get a little further where we do analysis and review, figuring out what's missing and what needs to be added to make these things actual commercialized products and services that people can consume at a market size. So that gets in the commercialization. You'll need capital oftentimes to grow and market your product or even to develop it. And then later on down the pipe, if everything goes right, you'll get acquired by another company, or you'll have initial public offering on a stock exchange. This is a possibility in our country, but then also people are going public on other exchanges too. So that's how the venture ecosystem looks in a nutshell. And so who do we engage? We engage investors, so angel investors. We have an angel investor accelerator that on-ramps new angel investors. We just last Saturday had our big venture conference where we invested in 2 companies. One is a drug manufacturer that's making a cure for type 1 diabetes with the applications in type 2 diabetes and oncology. And then the second one is a marketplace for nurse preceptors. So everybody that wants to graduate from a nursing program has to have some experiential learning at the hospitals. But the nursing staff in the hospital is not well incentivized to actually take them on as students. So only 1% of people that can do that economic activity do it. So this marketplace will make those people offer to help more students. So we'll get more healthcare workers, which we think is going to be a net plus to society. We coordinate advisors and mentors. So we have a private networking application that does AI matching for people in certain specialties at certain stages to people that need it at those specialties and stages. Service providers, you know, the typical things you'll need, legal resources, accounting, research firms like sales, coordination stuff is there. Partner organizations, so other entrepreneur support organizations like the WTIA, Life Sciences Washington. There's a lot of them around here that are set up specifically to help founders, oftentimes segmented by sector. So the WTA is very helpful with technology-based stuff. Life Sciences Washington is where you get more kind of the lab work. And then we have some coordinating infrastructure down in Oregon. There's also a consumer packaged goods collective here called Naturally Seattle. So consumer packaged goods are like your beauty products, your cleaning products, or these sorts of things that people build on their cooktops that ultimately make it into retail store shelves. Then different meetup groups. So we started off as just a meetup group, and then employee resource groups. So people that are working at the tech firms, perhaps some people in this room that might go to a Black Tech Night event to talk to them about what it looks like to invest in high growth companies. And we'll talk about what high growth means, or to found high growth companies. And so those are the people that you hear on the panel will be talking about that. And then, of course, startup founders. So people that are serial entrepreneurs, have founded multiple companies, future founders, people that are wantrepreneurs, or people that are already leading startups or are in the university looking at maybe starting up. So why do this? Well, because if we meet together as a community, we can get more Black co-founders and first employees of startups to improve the share of equity that people will have early on, to develop pipelines so that a founder doesn't have to go look all over town to find an angel investor. They can find them just here at home, and then don't have to look all over the place to find a VC that's going to invest in them. They can find it here at home, and so forth. Getting capital access to increase to Black startups to get us above that 0.4% that I mentioned. And then in order to reduce the risk and increase the value in startups. And so we'll talk about risk and value and how that plays into this whole equation. And then, yeah, to create pipelines so that we're growing new angel investors that have perhaps a desire to invest in Black founders, and then making sure that those angels are able to get a good deal history and then become venture capitalists in their own right. Why do all of this? And so this is where the kind of remainder of the talk will be, in addition to some of the technical details of the venture scale founding. But the main point of this is to improve Black generational wealth by ultimately building a globally scaled culture of regenerative startup founding investment. So what that means is this virtuous cycle of starting up a company, building it big, adding a lot of value to customers, earning a lot of revenue and profit in the process, having an exit event or an IPO or an acquisition, and then ultimately investing yourself in startups, right? So that we can keep this thing churning. And so if we're able to do that globally, there's a lot of evidence that that will help us secure a greater economic position in society. What does an economic position in society mean? So here we have a great diagram of a socioeconomic kind of pyramid. Credit to Rodney Sampson from OHUB. And so here we have three categories: talent development, new venture development, and economic development. So a lot of us maybe has had this experience in early exposure and socialization where we've gone through MESA or first robotics competition as a kid. That got us interested in math, science, engineering, and so forth. That gets us into any of these prestigious universities or these great professional societies around specifically engineering or problem solving, analytical reasoning, and really just things that can help us develop products that society can use or services that society can use. Then we'll go find ourselves some nice jobs. So we'll graduate from universities and then we'll go work for a nice FANG company, make ourselves a bunch of money, but then the upper part of this pyramid, we don't hear so much about. Everybody talks about FANG, but there are only 13 Black founded unicorns in the country out of something like 1,000 now. So this is the bit where Venture Black is stepping in to do a little bit of the lift. And so typically, so we do some help with innovation in terms of working in the schools and of course mentoring people on product development, but then really talking about entrepreneurship and then doing the market capital access, which ultimately leads to wealth and job creation. And so if we don't have a plan for that, other people will have a plan for us. These are some of our captains of industries celebrating the inauguration of J.D. Vance and Mr. Trump, which have not been so friendly to our business interests. So why does this matter in the Pacific Northwest? Well, we're the most tech talent dense region in the country, including the Vancouver metro area up north. And so we see larger ecosystems, of course, in the more populous centers, but we're the densest, the more people closer per area. So we should be connecting more and being able to, through those connections, deliver more economic value. We're also the second largest AI hub in the country. So new AI jobs per 100,000 people are looking pretty good in our favor. And this is the most scalable value generator in society right now. And so, but racially, like when we break down the demographics, we see that like home ownership has been kind of the focus of the Black community because we've been off the property ladder. Here we see like the 1939 stock market crash, the Great Depression, right, which is one of the most significant wealth cultural memories that we hear about in all of our school classes. But you see that worked out. People were able to climb out of the Depression, except for that Black home ownership has more or less been a prolonged socioeconomic depression, right? So we've made some gains, but still our high is where the Great Depression low was. So that has all these effects that we see in our society. So we're currently getting on the property ladder, but we also need to be thinking about business equity and what that means in terms of ownership and what that does for us as a society. So how does that break down to on a like average household basis? So the average white household holds like 19% home equity, but since we're just getting on the property ladder, it's like most of our home asset portfolio. Then we look at these other kind of asset classes, which will come into more import on this presentation. So we have business assets here, and then we have stocks here. And so we see that on the Black family side, we have only like 14% exposure to business assets, and then much lower exposure to stocks, right? But that's maybe not so good because here we have a chart indicating the growth of $1 in public versus private markets, and then also private real estate. And we see that the real estate, which is the largest part of our asset portfolio, is maybe not the highest performing. So here we have public stocks with the S&P 500 and privately held shares, which are in this private equity class. So we see that, you know, if we want to close the racial wealth gap, then we have to get the average Black family more exposure to the highest performing asset class. Generally, how are we doing when we go out and work in the tech fields? So the median, I think, tech salary in this region is approaching this 250 to 500,000 mark, right? So we have a slight disadvantage there, but as we see the numbers go up, this is where we're missing out. And so this gap is where venture state comes into play. So these larger wealth gains are often the result of people being able to found and scale large companies. And so if we're not able to field large companies, if we're only 13 of the 1,000 unicorns, we can expect this trend to continue. And again, these are the people that get to make a lot of decisions in society for better or worse. So in Seattle, how has that played out? So I mentioned that I'm 3 generations deep from Seattle. So my grandfather started one of the first Black-owned banks west of the Mississippi in the Central District. And so here we have a titled graph from 1960 indicating these black dots are 25 people. And we're all clustered here in this area. And so that was because in the 1930s, we were redlined there. So they said that this was hazardous area, suitable just for Black families. And you couldn't get a home loan if you're in one of these hazardous areas, right? And so, but that's 1960. So if we look here in 1970, just a decade after that, this map was created, we see that the population of the Central District of Seattle, this region where we were all at one point, was 73% Black. And so we see the magic of gentrification as we go through the tech boom and so forth, right? It just exponentially goes down. And the overall Black population of Seattle is trending downwards as well, right? So, so we've had the opportunity to flourish through this tech bubble, but through lack of ownership of it, a lot of people were consultants and different things like this. We're a little bit edged out of the profit side of this. The other aspect that I'd like to talk about is while we were working on redlining and getting redlined through the Securities Exchange Commission, passing a bunch of laws to prevent like flim-flam companies from being able to sell themselves to investors, we were also being redlined out of being able to invest in companies. So the Securities Exchange Act then created what's called a qualified purchaser. So you had to be of certain means to be able to invest in privately held companies. And that regulation is advanced that puts an income or net worth threshold on people that can invest in companies that are not registered with the Securities Exchange Commission. And so we're redlined out of one asset class, redlined out of another asset class. During the Obama administration, you get things like crowdfunding being an option, but there's a whole lot of kind of rigmarole in that, and it's all to protect ultimately the investor, but and the general stock market, so you don't have a giant crash event. But yeah, so that's how some of the history of this has played out economically. And so what have people been doing all this time? So building community through growth companies, right? So before venture capital was really invented. So this is my grandfather's bank, the Liberty Bank in the Central District. And so here we have the founders. My grandfather is this guy just here. He was an electrical engineer, one of the first credentialed Black electrical engineers in the country. He studied at University of Ames, Iowa, and they let him study engineering because they wanted to scientifically prove that the Negro mind could actually hold that amount of knowledge. So
Oh my God.
he aced all his classes and stunted on those suckers and started a bank. And so this is a nice plaque commemorating that achievement in 1968, which was the year that MLK was assassinated. So the civil rights era. This is that bank building now. Key Bank got it, and we put up a big stink to historically preserve the building. Couldn't get it done ultimately. We lost by 1 vote, but because of the press we were able to generate, we were able to historically, or actually to rebuild the building with a historical museum dedicated to the founders of the bank, right? And so Africatown Community Land Trust has some say in the leasing of this, so we're able to like stem the tide of gentrification. So as we see the graph kind of going down, we're kind of starting to like get a little gooseneck in there so that Black families can stay kind of in place and get access to learning programs to get people access to the knowledge economy and all this great wealth that we see around us. So there's also other history there. I don't know if, who has seen this picture before? Anybody kind of vaguely remember it? Okay, so this gentleman right here is Elmer Dixon. This is when the Black Panthers decided to arm themselves to prevent police from doing even more brutal things than we've seen them do recently. And this is Carolyn Downs. So Carolyn Downs Clinic in the Central District of Seattle, which is where my grandfather's bank was, is the last operating Black Panther health clinic that's still in operation. So Elmer Dixon was the founding member of the Seattle Black Panthers, and also we have the Odessa Brown Children's Clinic here. So a little history about Odessa Brown. So Odessa Brown came to Seattle in 1963 from Chicago, where she was a beauty student from Madam C.J. Walker, who is, pop quiz, first woman millionaire, self-made millionaire, right? So selling hair and beauty products. And so here's one of her factories, right? Humble beginnings. So Odessa Brown, this is her children's clinic that's still around in the Central District. But as we can see, there's also this building that they've built in Othello. So she's been able to grow her business posthumously and take care of Seattle's Black child population. So some more kind of history of investment in community and what it means and the progress people have made. So this is my uncle, Omari Garrett. So from 1985 to 1998, he held this building by force against the police in order to build a Black museum, because this was a school that they were tearing down in a Black neighborhood to build like another access ramp off of I-90 through a Black neighborhood. And they didn't have plans to build another school. So he was like, okay, here's the deal. It's going to be a museum to our progress, or it's going to be another school, or we're going to have problems. And so ultimately he won out. He just recently turned 75. So that's, you know, the progress, what it means to like invest in community, what the difference between wealth is and not having wealth, and the sorts of moves you can make when you do have wealth, and the sorts of moves you make when you don't, right? So the people that were helping build those institutions were largely parts of kind of civic movements, right? That were convincing more wealthy populations to act on their behalf. But what would it mean to actually be one of those wealthy populations ourselves? This is where venture comes in. And so we'll talk about kind of the scope of doing business. So on one side, there's kind of lifestyle businesses, which is kind of owning your job, where you own your time and you can decide when you go to market and when you stay home. There's kind of opportunity size, which is more the growth business. And then there's high growth, maximize the opportunity, where you might be inventing new markets. But in this case, you're really kind of stretching yourselves to go as far as you can go. So the different kind of factors to consider in each of these sorts of ways of doing business, we can say, you know, a lot of it comes down to kind of ambition, like how much are you willing to stretch yourself, because growing at these different paces of business will require you to develop knowledge and skills very fast and leverage skills that you already have. Funding, different scopes of doing business become more or less interesting to investors. So in the lifestyle business, you were probably just going to be working off of credit products and have to be like a cash flowing business. You wouldn't necessarily have access to growth income outside of being able to leverage credit or grants or different things like this. As you get onto larger opportunity size, this is where angel investors and venture capital folks, and we'll talk more about this, want to get involved. And then as you get to these higher growth market opportunities, it become more and more attractive to investors, because even though there's high risk in any given startup business, there's higher rewards. The upside starts to look better. And so here we talk about risk a little bit, and then exit strategy. And so it's important to kind of talk about this. So I mentioned acquisition or IPO, which is initial public offering on a public stock exchange. And so for the higher growth opportunity folks, that becomes an avenue by which they can finance the growth of their company. For the lower kind of growth sort of people, really they're focusing more just on maintaining ownership and control of their company, and maybe hopefully selling to a relative or to a private equity company or something like this if they've built up enough infrastructure within their business. And oftentimes people don't. So in this middle category of growth, this is where people have really built a machine for their business that has standard operating procedures, assets that are kept track of really well, and so forth. And so this type of business is the kind of business you can really sell on. This kind of business typically leaves with you, and this kind of business becomes something that, you know, could last for a century or more. And then some examples. So here we've got freelance services, lifestyle blogs, artisanal businesses. For growth, you see like franchises, like in Anytime Fitness, you might, you know, see someone buying up a bunch of those. Or, you know, in this high growth thing, this is really our Silicon Valley style tech startup, you know, really disruptive and growth ventures. And so we'll talk about like what that means. So what is venture scale? So to talk about this, we have to talk about kind of what is the size of a market opportunity. And so you'll hear these acronyms, TAM, SAM, and SAM. Who has heard these acronyms before? Okay, good. So I'll just go over them real quick. So TAM is the total addressable market, the total number of potential customers. I won't go over the specific equations. So service addressable market, this is the total number of potential customers, but then it's the fraction of that of the people you can actually serve. So if we're talking about all the people that are ice climbers that need ice pickaxes, but you're an online retailer, you can only sell ice pickaxes to people that are shopping in online retail stores, which is a subset of all of the people that are buying ice pickaxes. Sorry for that somewhat abstract example. The last one is this service obtainable market. And so this is really, okay, so this is the market you have access to given your position, but what can you really capture? Like, and this is typically more of like a, what are you gonna do in the next 2 to 4 years, the short-term kind of picture. And so a venture scale company has intended its trajectory to be one of significant scale. So of global reach, oftentimes this total addressable market will be like a country. What are all the people buying ice pickaxes in a country? And then the other consideration of this is the people that are founding these companies that are growing this rate are not so much interested in specifically the revenues that they're getting from this business activity. They're looking for the revenues that they're going to get selling the machine they just built, this startup, this business. If they construct this thing that can acquire wealth at this rate, then they can sell it for a multiple. So they don't have to wait all that time. They can sell it for 5 times its value today. And if that value is, you know, hundreds of millions of dollars, then they made out and they're set for life and they can do the next thing. So what is venture equity? So when we talk about growth capital or something like that, we have to kind of look at how it manifests in society. So this might be you today, just having an idea. Then you have to convince someone else. So this is your first sale. You have to sell someone else on your idea, potentially to address any deficit you have. So maybe you're not a technical founder. Maybe someone else has coding skills. Maybe you don't have sales skills. Someone else does. So eventually you split the pie here. And then, you know, now you're like, okay, well, we have a little MVP or sort of thing, or we, you know, have our idea of what we're going to build, but now we need money to pay our server bills or what have you. So you have like a nice rich uncle or aunt, as the case may be, that's going to go ahead and give you what's on this y-axis here, which is your money raised. So he went ahead and gave you $15,000 to buy 5% of your company. And so, you know, thank you, uncle. He also makes you get an options pool just in case you bring on employees. So he's a savvy uncle. Then you've done really well there and you've been able to develop your product and go out to market, but now you need extra employees because people want to buy your thing and you can't service all of them. So now some angel investors give you $200,000 to buy 16.7% of your company. So everybody else is getting diluted. And so that's kind of like how the investment scenario works, and so on and so forth. But the most important thing is, so you start with this friends and family round. Then you're raising the seed round when you get closer to having like a nice MVP that the market is saying that they like. In between though, because this graph is a little out of date and they're always kind of adding new sub rounds and post rounds, there's this pre-seed round, which is where you're going to be going out really to your first angel investors and to your early stage VCs and things like that. And so that's what Greenwood Ventures is. And then there's this bit called valuation. So essentially this is the value of your business machine at any given point in time as comparable to other companies that are delivering value in your same space. So as you can see, as you go up these rounds, your valuation goes up and the amount of capital you need to raise goes up because you're using this capital to do things like fund your employees here or buy yourself these nice buildings that escalate and need your signage on them. Ultimately, the idea here is 100% of nothing is a lot less than 17% of a big company. So as you're getting diluted down, we see here that you start off with 100% of the company, but by the time you get to this initial public offering on a stock market, you've only got 17.4%, but that's 17.4% of a $2.6 billion value company, which is a pretty nice chunk of change. So that's why people do this economic activity. And so if you want to go start yourself a new Carolyn Downs clinic or a new bank or whatnot, it can help you to get there by using startup money. And so people have done this to great effect, especially those people that we saw in that photo with Mr. Vance. So, what do we need to do at each of these funding rounds, right? So venture scale company typically progresses down this trajectory. So idea stage, minimum viable product. Sometimes you're pre-product, sometimes you haven't earned any money, so you're pre-revenue. Sometimes you haven't raised any capital, so you're pre-venture capital. Your seed stage, which means you're just kind of starting to get product market fit. Maybe you're profitable, maybe you're not. But then when you start to need to grow your company, there's these A, B, C lettered rounds for you that ultimately, if you've done everything right and you've met market really well, then you get acquired by someone that likes your business and would like to make growth capital off your product. And then, yeah, not everything needs to be a venture scale startup. Some things are good just being like a neighborhood bar. Some things are good, just servicing your passion, right? Because ultimately, you've got the most valuable thing you have is time. And the best thing you can do with your time is align your economic output with your purpose as a person. So if your purpose is not to grow one of these venture scale companies, then don't use your time that way. But if you think that you could, and you see the value of doing this as an economic activity and all of the ways that you can build value for your culture and your society, then you'll find yourself on some of these stairs. So at this seed level, you're really building a product and trying to find product market fit. And so before that, the pre-seed stage, you're looking to build like a minimum viable product. So you've got your laptop out, you're writing some code, you've got some cloud app, you've got the nice mobile app or something you're developing, or maybe a robot, or maybe a drug, whatever it is. Typically, unless you're in a heavily regulated industry, best advice on that is to, if you're not embarrassed by the thing you launched to market a little bit, then you waited too long. So get out there, let the customer tell you what they need you to build from that point on. And that's how you get yourself closer to product market fit. Then in the Series A, you're typically looking at how you're going to grow and lean into product market fit. At this point, you have like a more mature product where your customers have told you what they like and you've implemented a fair amount of it. Then we get to this Series B where you really need to exponentially grow and your investors need to know for every dollar that I put in you, how many dollars can I get out? If a potato will do it, I'll buy that. But since you say that you can do it, I'll buy you. Then we say for Series C, it's really achieve and maintain profitability. So at a rapidly growing scale, getting there. And so this is where you need to really worry about your corporate culture because all the decisions you made in terms of who you're hiring and how you communicate your values. Now, when you can't directly talk to people and you're above like Dunbar's number of 150 people, now it's kind of just in the wild. So if you've done a good job as a parent, then your company will profit at this stage. And then you have to grow while staying profitable in Series D. And all your investors and the market will be looking for that. So that is that roadmap. So who else has done it? These are companies that we know and love. Gusto, if you're into HR for startup space. GitHub, if you like writing code. Canva, if you make presentations just like this one. Notion, if you're doing, project management or just note-taking. Miro, if you like doing diagramming, right? So what we have is this little triangle is when they first had live product. The square is when they got their first customer, and the circle is when they felt product market fit. So I mentioned that word a few times, and that means that's when your customers are really like dying for the thing you got. So you can see here, Companies that have got it really together. I don't know what Sprig is, but Gusto, right? So bam, 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 all within the first 6 months, they got everything lined up, right? As we get further down to like Airtable or something like this, they started off, right, with a live product, but then it's 4 years later, really, that they've actually got their first customer. Or, sorry, am I looking at that right? No, so it's like 2 years later, so that they got the first customer. So what's going on here? So in this space, they're doing a lot of like customer discovery and they're pivoting. The story of Slack, for example, is that it started off as a gaming company, but then didn't actually make any success there. And so the venture capitalists gave them the option to keep the money, but pivot to something else, and they did, and that's how we got Slack. So there can be a lot of time between your live product and then finding, getting your first customer or getting product market fit. But this is, you see it ranges the gamut of, up to 5 years. It can take longer, but ultimately you're up against the burn rate of how much money you're expending versus the rate of you getting capital from investors or from customers. Why do startups fail? Okay, well, the top 20 reasons why startups fail. One, nobody wants your thing. So if you built it and they didn't come, that's on you. You should have been asking questions. You ran out of cash, so you didn't get enough people that had the intent to buy your thing for the right dollar amount, or it cost you too much money to go get a customer through your marketing than it did for them paying you for your service. Founder crashes out, people can't work together, get out competed, so the list goes down, right? And so these, vary in severity, right? But we see that there's a pretty decent amount of risk here, right? So this is what's going through the mind of any given investor that's kind of looking at your company. And these are risks to be aware of as you're founding your company, so that you can kind of hedge your bets and choose the people you work with and make sure that you're doing the most important thing at any given point in time to stay alive. So why, given all that risk, do investors even look at this thing? Why do you go on Shark Tank and someone says, I'm seeking $500,000 for 5% of my business? Well, that's because if we look here, this is a Monte Carlo simulation of 35 different startup companies with math basically that just shows the average time to fail of a company or the average return multiples and things like this. So we see that most of these companies have a tendency towards zero. So they fail often, they fail early. And here we see 56% of companies fail. 35% of companies that get invested in, they're marginal gains. And so here we see it represented in a pie chart. And then 9%, right? One 10-sided die will get you 10x. So people are investing because if they get a portfolio together like this, there's going to be a couple of these spikes where it returns. And so here we have one that's 2,000% return. And so would be good to have that one. So you got to go kiss yourself some frogs as an investor. And so that's who is investing in these high growth companies. That's what these high growth companies are doing. And so now you can kind of picture yourself. We're in DocuSign Tower. Someone decided e-signatures needed to be a thing before there were even laws around that. And they made it happen. There's a great Netflix documentary called Super Pumped, which is a story of like Uber versus Lyft and the Transit Authority in New York. And so you can go and see how all these people contended to create these new markets and how to grow these very innovative products that make our society better, arguably. So that's me. It's did anybody have any questions? I'll leave this panel up here so we can make introductions. And if anybody, does anybody have any questions?
Oh.
Take it off. So,
can you speak into the mic, Terrence?
So, this is really good. I appreciate it. For someone who's not, I guess, exposed to this space, like maybe you didn't go to school to study STEM or business or anything like that, but you're interested in like economic mobility and being able to invest, but you're not connected to this world. What would be the best way to connect into this? Would you say that potentially being a founder or finding a partner to kind of invest with them in their venture, what would be like a pathway in your opinion?
Yeah, I think a great way is to just go to a meetup group. And so you can find people that are doing hackathons or people that are specifically looking at founding ventures. And yeah, you can get that one, sorry. And so that's kind of an easy way to find a co-founder. There's a lot of startup entrepreneurial ecosystem stuff going on. There are different ecosystems that are more active than ours. So like New York or the Bay Area, different areas like this, they'll have this conversation going on at like 11. So you can go tap into that and then bring some of that goodness back to your local home state ecosystem. But yeah, that's my advice would be to go out and meet people that are doing it. And so today is a great opportunity to meet some of those folks. But yeah, that's where I'd get started. Back.
Yeah, my name is Dom Gordon, and I'm just curious, what makes a good founder? Like, if a person is interested, they have a vision of something they want to work on or create, or they just want to create better economic opportunities for themselves, their family, and the people around them, their community. In your experience, what have you seen to be the best qualities or the most important skills that make a person a good founder? What should we focus on?
Yeah, I think that one of the more important things is really passion for the sort of thing you're doing. Because if you're passionate about solving a problem, then you'll align yourself with what you need to do to get it done. And so I think that that's one aspect of it. Then I think that the sort of idea that they have and their ability to execute on that idea. And really the way I think about that is that ideas are a multiplier on execution. So the person has to develop themselves to be able to really execute on whatever idea they have. And a person that has higher ability to execute or a team that has higher ability to execute, if the idea is maybe mediocre, they're going to figure out how to make it a better idea. They're going to be the team that figures out how to pivot and figures out how to solve the issue. A team that doesn't execute so well, you can give them a great idea. They're going to fumble that ball. So I think that's the main thing is become a competent executor and be in love with the problem that you're solving.
We do one more question then.
Yeah, then we should go to the panel.
No.
I come up.
What's up, Evan? Thank you for this. So I'm just curious, obviously, majority of startups don't pan out the way they want to ultimately be in their first go around, and they go to this place of oblivion and failure. But there have always been these key successful stories of people who are able to rebound and have the perseverance to succeed again in a future endeavor. So I'm curious, in your experiences, what have you seen from those rebounds, the characteristics or specific traits, whether it's individually or collectively, that have ignited those second goers to really succeed in that second round of startups?
Yeah, I think that's a key differentiator psychologically for people is, well, one is people from different economic backgrounds have the opportunity to absorb risk differently. So I think that people that are, really coming from the back foot, as they say, are often faced with the idea of, well, this was my shot. So what am I going to do from this? And so a certain smaller fraction of those people will be like, I learned enough from this, I'm going to go again, right? And so I think that's really it, is people are observing it and they are realizing that they're not failing, or at least not failing in an undignified way. They're failing, but then it's really failing to learn. And I think that the biggest differentiator is people that are learning from failure or view failure as a learning opportunity versus people that think of failure as like a sign of weak character or something like this. And so you see the people that succeed the most are people that are able to typically raise enough resources to weather economic shocks and risks and really de-risk their businesses and get revenue in the door. And so I think that people that move themselves in that direction are doing well. And I think people that don't take it personal, if there's not a market there, if they can't find product market fit, people that have strong ideas that they hold loosely. So if the market tells them that's not the thing, then they move to what the market needs, right? That they don't put a lot of ego into it, even if they're passionate about it, and they really learn what value is, like generating value for the customer. And people really that have that idea in mind will typically do well. All right, I think that's all the time we have for questions. And so we'll go ahead and introduce the panel. So if the panelists would like to come forward.
For that.
And just for my benefit, would you align yourself with your picture? Okay. Not that I don't know who you are, it's just it's a peeve of mine when people are out of order now. So, okay, so go ahead and do a round of introductions, and we'll start with A.R. Bell. Can you tell us a little about yourself?
Well, hello, everyone. I'm A.R. Bell. A little bit about me. I'm passionate learner. I think that's just the best way to describe me. I love learning. I love like digging into things I pretty much have told I couldn't do at some point in time in my life. I come from Google. I'm a software developer from that era. I worked at Microsoft. Saw the need for finding subs. This is where my company started. When I traveled, just had a problem with like, finding people to play with or finding people to fill in teams. And I started asking people, and they were like, I have the same problem too, and we can't find this. And I started looking at some of the tools out there, kind of had imposter syndrome, put the idea aside for many years, and saw an app actually that wanted to start in Texas, raise $1 million for their idea. And I kind of looked and said, that should have been me. And I said, I'm going to do this. I just need a sign. And to be honest with you, the sign was, I was part of the layoffs at Google. And I said, this is the sign. Literally, I mean, if this is it, I should go at this. And that same day, somebody reached out to me to join a nano degree or a nano accelerator. And here I am with Gametime Hero, an app that connects participants and organizers and makes it streamlined to run active communities.
Thank you.
Great story. My name is David Cotter. I am currently the CEO of Greenwood. It's a digital banking platform focused on the Black community. I've been doing startups for quite some time. So this is my fourth startup. I've done my tours of duty at Microsoft, Real Networks, Amazon, etc. So, I'm excited to answer any questions, share all of the mistakes. We don't have enough time. But certainly connect on LinkedIn if I can help in any way. I would love to see the community, and very specifically the capital access community, entrepreneurs supporting and talking with each other, I think cannot be overstated. I mean, I think you had a great question around what makes a great founder. I don't think there is a single answer. I mean, other than you're crazy. But it is, I think, a very compelling question because it is very, very difficult. And I would share with anyone, I think one of the top qualities is just learning how to manage your emotions and your own mental health as you go through the whipsaw of every day, going up, down, sideways. It can be very, very taxing on one's mental state, their family, their friends. And so there's all kinds of things that go into that. But I think one that gets overlooked a lot is just the mental stamina and the importance of maintaining the kind of mental stability through the ups and the downs.
Well said.
Okay, hi everyone. My name is Chuks Onwuneme. So I'm the co-founder and CEO of Identities.ai. It's a platform that helps enterprise secure their digital communications in real time from AI impersonations. A little bit about myself. I've been in Seattle now for about 14 years. I'm a computer science engineer by training. Let's see, started my career while I was in college and at IBM as a software engineer. Then after that, I joined Nokia, designing smartphones. Spent my time up in Finland, where I helped build the smartphone OS that powered billions of devices globally. really great time there. After Nokia, I moved up here to Seattle after the Microsoft acquisition. I did not join Microsoft, but I ended up in Seattle because I guess I had gotten the itch to start building companies. I was not aware that I could build companies while I was at Nokia, but somehow when I left, I just from talking to a bunch of folks, I realized there was a place called Silicon Valley, which I discovered after I left Nokia. And when I went there for the first time, I guess I kind of found my people. So I'm a build at heart. I build products and I thrive in building products. So since I've been here, I've built a couple of startups. The last one was a healthcare tech startup that ended up being a pretty big VC-backed company. Left that company a couple of years ago, and I'm now in my third startup. So I've been through this journey myself, and also happy to answer any questions you might have.
Yeah, I'll go ahead and kick us off. So a question I had is, so we got a powerful story of Jeff Bezos, right, getting in, starting Amazon, like Bert and Ernie, just these servers sitting on a table that he bought from Home Depot. And so you got this door desk award situation where it's like actually used doors as desks. And that implemented a culture of frugality at Amazon, right? And then, saving money so they can spend all that money on the customers and whatnot. And so I was wondering, in your story of like how you grew your company, kind of what were those early days like when you were founding with Pillsy?
Talk about frugality. Yes.
Well, I mean, just generally, what were the early days like? What did it look like? Because I think so many people see, the polished, finished product, but they don't know what the beginning of something looks like.
So I guess for us, let me talk about, so when I started Pillsy, I was coming out of the previous company I had started, which failed, right? So I wasn't really looking to start a company. But I met a guy who I met in Seattle, and I had worked on this problem in the past. And essentially, when something is pulling you, you basically just know this is really something you need to go solve, right? So I personally wasn't very sure what was going to happen, but the fact that I loved building products was really what got me into it. And after 6 months of just working with this guy for nothing, right, we realized we had to start a company, right? And it was hard because, again, I actually didn't set out to start a company, right? But the first year was really, really hard for us because at the time we're building a product that didn't exist, trying to bring in something into the world that just did not exist. And we were not both from healthcare, but we're building a product that we felt would solve a massive problem, right? So I just went into it with just honestly the love of building products. Because if someone had told me that this was going to be hard, I most likely would not have done it. And that's just being honest. But the fact that I would build what became the world's first smart pill bottle was something quite remarkable. I didn't think about it that way when I did it. But we had a couple of times where I felt like this wasn't going to work. Let's just kill it and move on. But we just kept on going. We, mid probably second year, we ran out of money, right? And what did I do? I just went out, did some consulting work, got some, cash flow, and I came back and I continued. But what kept us going was the fact that, when we started having people tell us that this product was needed in the market, that was all what did it for me, right? And the fact that it was a healthcare product that people were actually using once we finally built it. And it was a hardware product. We built it, went to China, had a manufacturer brought it out here, we launched it, and real people were using this product. I still remember, and this was something very personal to me. I still remember when we put it out on Facebook, and we had a ton of people just literally just pouring out their hearts about how this product has just saved their kid's life. And I'm going, holy smokes, I never expected that, right? I still remember this lady just wrote a bunch of, she poured out her heart on my Facebook. It was a public page, and I was like, we gotta shut this down because I'm not sure if this is legal.
HIPAA compliance.
But I mean, she was telling us about, I mean, kids who were like suicidal using the products, right? I just never expected it, right? So when I saw those things and I saw the impact it was having on people's lives, that was really what kept us going, right? That particular product, what happened was ended up being very early for the market. The time wasn't quite right because to get a product like that in the healthcare system, we had to have a bunch of things put in place. As of 2017, 18, those things were not in place. So we ended up in a pivot and got into a much larger opportunity, right? It's funny, we don't even have that product anymore, but even to this day, I still get emails from people like, hey, I want to buy Pillsy. I was like, oh, we stopped building that a long time ago. But those early days were filled with a lot of doubts. But what, again, got us going was when we finally launched it, because it was a physical product, right? That's, it's hardware and software. But I think we did like 3 years R&D from 2015 to 2018, not 27, 2 years. Those 2 years were really hard, really tough. Mostly had to do with money, because we didn't have as much funding. We got like couple of accelerators, but the fact that we're building a hardware product made it a lot, like 10 times more expensive. But it was a crack team of 3 dudes who built it, right? And when we finally had it built, and we would show up at a pharmaceutical executive's office, and they would expect, like a large team, to show up, and it was just 3 guys, and it was one of those, like, we would actually dress ourselves up and like show up in like, suits and everything to make it look like, we're like some big company. It's just 3 guys, right, who had no idea. But anyways, good stories back then, but a lot of it was just pushing along because we actually believed in the product, right? And we saw the effect it had in the market.
And so, Dave, what was your first startup, and how did you kind of come to the realization that you were going to do it?
So first startup was, it was called Empire when we first started. It was the thesis at that moment in time, I had worked at BEA Systems, which had acquired a startup that Todd Nielsen and Adam Bosworth had founded, and it was very specific around web services and service-based architectures. And so the thrust behind Empire, was how can you quickly assemble or orchestrate a series of web servers to create kind of customized small business applications. So depending on a series of questions, you can customize it. So when we ended up kind of being done with where we thought the market was going, it was kind of a lightweight ERP system for eBay sellers. So that was the first one, and it's Ignition Partners funded it. We raised $8 million out of the gate, and it was my first startup, and it's funny because I was thinking as you were asking the question about early days in the startup. Early days in a startup, if it's your 3rd or 4th one, are very different than early days in a startup than your first one. I was overly confident. I did not really know what I was doing. My imposter syndrome, it was at 11. I did not know how to manage a board. I ended up with $8 million and thought, well, shit, I have an org chart. I'll go hire people. Like I made every single mistake. Along the way, we eventually got the product in the market, and kind of what ended up happening is we launched the product, and it had, its modules. And then we realized, of course, in hindsight, we should have known better, but we realized that eBay sellers don't like to spend money. So the minute we started to charge, it was like nothing. So we were like, shit, that's not a great business model. But we found that they were also doing a lot of looking up of prices. How much are things selling for? And they were looking at Amazon and looking at eBay. And so we were like, okay, well, let's scrap the ERP thing. Let's just provide a pricing tool. And all of a sudden, we got a lot of consumer demand. Then we started producing these kind of widgets for customer acquisition that would basically take price trend information of baseball cards or Pixie sticks or all kinds of these crazy random things that are being sold on eBay. We use those as ad units, or basically customer acquisition units that other people put on their website, and we started to get more attention. Then people started asking us, well, what's the right place to lay out the widget on their page to get the highest click-through based on audiences that they were serving? So then we had an instrumentation layer, and then we ended up selling the company to Comscore for page level optimization so that they had a way to tell people where to place different widgets, units, etc. on their web pages, and it would basically measure it. That was one hell of a journey. And it was, I think, it's what's very interesting, at least for me in that particular, certainly in that experience, is the difference between the moments and the lessons. You know, you have those moments where, you know, you either move into a building and you're like, oh my gosh, we have an office space, or you see your sign, you know, next to some office door, or, you know, you hire your first employee or your second employee, or, you know, you go have a customer feedback session, and, you know, or even you have a bad board meeting. I remember the first board meeting had 68 flipping slides. Like, who that, like, it was just so ridiculous. But the lessons learned, like the moments in time were fun, but it's the lessons learned that really, really got me to be a much, much better CEO. Frugality, or really thinking about how to spend and when to spend money, understanding, you know, the needs that you have in the business and how do you invest and fill those gaps. Product demand, and how do you get a signal on customer demand, customer behavior that leads to potentially a purchase. How do you get that signal as early as possible? How do you transition from being a manager to a leader to a founder, and being super comfortable with people not liking you and not going out of your way to try to get people to like you? That stuff's harder than it sounds, you know. Be like, I'm gonna be a hard ass. There are not that many, you know, Jeff B's, you know, Steve's, etc. That's not a natural muscle for people. And so learning how to confront and challenge in a positive way, in a comfortable way, in it stylistically that matches you, I think are some of the most notable lessons to be learned. Okay, I'm rambling, but yes.
No, I think that's great. I like the way you couched in terms of like it's not a natural muscle for people, because it is, right? You keep working on it, you have all these interactions that demand that sort of behavior, and so eventually it becomes second nature. And
I'll just add one thing. To come back to your question, there's a great founder can be a shitty manager and a horrible CEO. A great CEO can be a horrible founder and an okay manager. To be a great founder requires, in my opinion, a level of focus, grit, determination, and crazy confidence that allows you to just persevere. Being a great CEO means you understand the business model and how to evolve the creation of the company. Being a manager is setting the targets and motivating the team and keeping people moving along. And you have to wear all three hats. And that is, you better be real with yourself about which one you're good at, or two, or maybe three, or where you're not good, how to supplement that. But just remember, you have to wear all three hats. Great founders may not necessarily be great CEOs. And so that I see a lot, where people just kind of assume that, oh, I founded the company, I'm the CEO. No, you're not. You founded the company. When you have 10 or 15 people, let's have another conversation about what a great CEO looks like. So,
yeah, you have to grow your skills very rapidly. Thank you for touching on that. So AR, you're currently in the middle of your first startup, or kind of at a certain point with it. And so what are those early days like? So you got the severance, you were confronted with the option to do your own thing. You discovered this problem that meant a lot to you because you were involved in league sports. or pickup games. And so how did you go about navigating that early start? So perhaps if you have a partner in your life, like how did you couch that conversation?
Thank you. Thank you for calling it out because I couldn't do this without my partner. So I hope she sees this video, right? So she can see I'm calling her out. But yeah, I mean, like, honestly, I got a little bit lucky with my start. One of the things about me is I love learning, and I try to, it's hard to take away the fact of feeling like you're attacked when people give you feedback on anything, right? It's one of the hardest things, but it's one thing that I did really well. And the reason I'm bringing this up is I had this idea for many years, and I had got a book from someone. It was like, I think it's like how to build your startup and raise your first million in the first 12 months or something like that. It's a comic book, but I forget the exact title of it. And someone had suggested I read it. And in the book, it talks about going out and really just surveying people, right? Like do that as your first thing. And I saw this, and then I got an ad for, I think it was like Traction First, another book from an online camp, and they say that first, like survey people. So I started asking people about like, hey, what's the problem that you guys are having finding subs? And of course, I was like, I know the answer, right? I know what it is. I don't even know why I'm asking this question. Everyone's gonna say the same thing. No one said the same thing. Everyone said, this is the problem. This is the problem with finding this. This is a problem. And I was like, okay, so I don't have the answer yet. And just so you know, I had already started building a software. I started building a shitty MVP product on that I have, excuse my language, but like barely worked. And I was like, man, this is going to change things because this is not the problem. They also need this part of the code base. So I ended up conducting probably around 1,000, maybe 200 surveys. And we have them in our database now. We still go back to them and look at them like, okay, what were they telling us? And the early days were like that, just like finding that this product, it needs to, before we even build, we should have prototyped a lot more. But what it did was, I pretty much, since I am a developer, I was able to like kind of mitigate, like having someone else build it. I kind of would be like, hey, I'm going to build this, and then to ask you what it looks like. And honestly, a lot of my friends who weren't in startups, they were like, why are you releasing a shitty product to us? It barely works, doesn't make any sense. Why are you doing this? And after reading these books, a lot of them, just like you said, like, which I snapped at, was put a horrible product in front of people. Let them give you feedback. And this is a truth. By putting that out there, it kind of started, yeah, it doesn't work. It's barely worked, but there's some gold here. And here's the feedback I'm going to give you. And then what I would do is within a week, I would go, okay, I'm going to reiterate on this and then give them back and say, here, I did all their feedback. Here it is. And in the first year, yeah, it was super slow. But now what we're seeing is I had a couple of clients, it's super almost scary to say, but I've had people find me on the internet, like without an ad, without running a campaign, but they started using a product that we had, a part of our platform that we haven't even released yet. And they go, hey, this solves my problem. And like, why are you not promoting this? This is great. And it was I kind of looked at my partner, I'm like we started screaming like, oh my God. And then the next week, it was 2 more people that did the same thing. Right. So I don't know. That's, I mean, a long-winded answer to that question, but that's kind of what the early days are. We still are in the early days. We're still learning. But one of the things for me, I would say, if you're interested in building a startup, is really when people are giving you feedback, learn it, write it down. Don't think that you know the answer. Because the more you can iterate, it even tells your customers that you're even listening to them. Right.
Can I add one thing? That was so well stated. So well stated. One of the things that a big lesson that I think what he was talking about that I don't think can be overstated, and that is there's clarity of the problem, and then there is what is the right solve for the problem. And the more iteration and feedback you get from customers, one, if not both, get much more hardened. And it oftentimes, I've seen a lot of startups, everyone gets the problem, but the solve for the problem and the right solve that you can build a business from, not a feature, not a product, but an actual business. That's kind of the nuance that you need to sort through in those early days, where you're like, I know there's a gap, but now how do I solve that gap in a way that is more than just simply a drop-down feature from a major competitor, that is more than a product that is interesting, but I can turn that into a business, which in turn can be a company. That's some nuanced shit, and that is really hard in those early days. And the only way you can get there is get as much feedback from customers up front as you can, along the way as you can. It cannot be overstated. That's when you run out of money. That is,
No, I really like what you're saying. I think that so kind of on last week we had a panel, and I think one thing that really stood out to me was the customer's investment in your product, whatever it is kind of the first real investment. So if someone's going to spend their time even looking at the thing you put out there, you should be thankful for that and then recognize it as an opportunity to kind of like follow a signal on it.
Yeah.
Even if it's, you know, a pre-revenue sort of thing where they're not paying any money, but then even figuring out like, so how do I know that this is like a real thing that you'll pay for? Like, and I guess
Yeah.
that's an important thing, right? So that's the difference between a project and a product, is whether or not someone's really going to ultimately buy it. And so how did you, and this general question of the panel, and maybe we'll start with Chuks, like how did you first recognize, or how did you turn into the money the first time? And how did you orient yourself to get that product market fit and really get those customers after you?
Pretty good questions. I think it kind of depends on why your why, right? Like one of the things I'll always say is, why are you doing this? Like, how did you get into this problem, right? For me, I'd say, let's say, going back to my first, what I call my earlier startup, like I said, I wasn't looking to start that company, right? I was not from healthcare, right? But the fact that I met someone who essentially had that background, right, was what got me into it. And the fact that when I saw the problem and I saw that what we were building could ultimately be a solution, right? That's what really got me into it. But then when it comes to healthcare, it's a little different, right? Because, you have different pieces of the puzzle, right? It's like, who are you selling to, right? Not sure how much folks know about healthcare in general, but it's starting to change. But, back then, at least most healthcare products where you're selling direct to consumers, very hard. Very, very hard. Most healthcare startups tend to sell to enterprise, right? Selling to the healthcare system, either to the payers or doctor offices or whatever. So for us, we actually earlier struggled with who do we sell to, right? So we had this product to solve the problem. Everyone, saw the problem. I saw what it was. But for us, we sort of struggled with who do we go to first, right? And we struggled with actually finding our first enterprise customers, right? Because those sales cycles were crazy, right? So what did we do? We just put it online, we put it online, put it on Amazon, and folks were buying it, right? Even though we were not, quote unquote, a B2C type company, we're like, if folks actually want to buy this product and they'll buy it, we just put it out there, right? And even though that was not really our business, right? But that sort of gave us, in a way, conviction that we had something here. We had the product, we tried to sell it into some of those healthcare systems, we couldn't. But then on Amazon, this thing was fine on the shelves, right? Yeah, so we built conviction that way, and along the way, we tried to go, upscale, up market, going to enterprise. The sales cycle were like just crazy. We didn't have funding for that, and eventually we realized, there was not really headway for us, right? To try to get into the market we were trying to go into, so we had to do a pivot, right? And that pivot was something that was what we had to learn. It was a combination of a couple of things. One, the timing was right. Secondly, we had learned a whole lot. And third, we had actually built a platform that could help us with the next thing we did, which is what happened, right? And by the time we turned things around, we were making, revenue, right, from pretty much day one, right? And so that was like, what we had learned from, what we had built prior to that.
Yeah, that's interesting. Taking that pivot. Dave, did you ever have to go and pivot when you were working with the startup?
All of them. Yeah, definitely so. Empire, the very first one, like I said, it was like ERP pricing widgets, page optimization for ComScore. Like, if I didn't start a company to sell something interesting to ComScore, I couldn't give two shits about ComScore. But it was a natural evolution of where the signal was effectively taking us with what was in front of us, and so we just followed it. I'm going to, and it's not even a bold statement, but like, I hate the word product market fit. So if there is a word that is the worst word, the most ill-defined, oversubscribed, non-useful phrase for startups, it's got to be in the top three. It doesn't matter, because its definition is too broad, can be completely different if you're talking to a partner versus an investor versus a co-founder. The variations and the variables that make up quote unquote successful product market fit do not uniformly apply. And I think when you look at our businesses, you know, as he's talking about revenue, you know, what you're really talking about is kind of one of two things. What does traction look like? And what has to be true for me to get funding the next time I need money? And that funding could be self-funding, but at the end of the day, when you look at the number one reason, or one of the top two reasons startups fail, it's they run out of cash. I don't believe that there are many dumb entrepreneurs. I think entrepreneurs are pretty damn smart. Give them enough runway and they'll figure it out. So ergo, when you think about the business you're in, if you're in an enterprise business, your exit and your next funding is going to be based on the market segment, and are people buying and paying enterprise pricing that then can be added as effectively a feature down the road. If you're in the consumer space, or, you know, it's going to be about how big and how many people have you attracted, and how quickly have you been able to get to a certain number to do a certain thing efficiently, or has it been really hard? If you're in gaming, it might actually be, you know, both the construction of the game, but it might also be engagement. What's the repeat activity? Like, just know that you're trying to answer and get to a point of what does traction and what does good traction look like in the industry that you're in at the stage of your company. Get square on that, and just don't let anyone talk to you about product market fit.
So I want to add to that. Perfect answer. Absolutely love that. And I'm sure we should talk, because I'm sure I can learn a lot from you. One of the things that I got early on, actually early on was last year. So last year, we got in contact with Groove Capital. Groove Capital is an investment firm in Minnesota, where I'm originally from. And we were having our first meeting of some of the potential investors and our advisors. So next door, Groove was sitting down, and I saw him, and I was asking my partner, I was like, I'm gonna go chat with him. I know he was known as a hard ass. And I was like, look, I did a product market fit, like document. I know that we have 40%, because that's what they say in the product market fit. Like, you should hit 40% of people that's would be very disappointed if you didn't hit your product. I was like, we finally got it. So I'm gonna go tell him that. So I went over, I was like, hey, you got 10 minutes? He's like, yeah, come on in. So he sat down. I was like, look, I got this. Like, I just want to know, you know, what's your thoughts? He was like, it's bullshit. Pretty much what he said. And I was like, tell me more. And, you know, most people would say, like, they would kind of feel defeated, but I felt bad. But he was like, here's what it means for us. I want to see growth, like, not just on paper, but I want to see how many users do you have now? And I think we had, like, at the time, we had just had maybe 300. He was like, in the next 4 weeks, can you get to 1,000? It's like, if you can do that, we invest. You better fucking believe I got 1,000. There was nothing that was going to hold me from that. And to the day, I went back to his office and I said, here's 1,000. And, you know, we're actually on track by, you know, August this year, we're going to hit 10,000. I did more learning about he's giving me other feedback. And he was like, well, that's product market fit. It's a mix, kind of like investors will have different meaning of what that means for you. You will have different meaning for what that means for yourself. Your customers almost will have a different meaning. So it's about kind of merging that, but also knowing that it's up to the knowledge holder, I would say, if that makes sense.
And so you worked on, you're working on a pre-seed stage round, is that correct?
Yeah.
And so you two gentlemen have raised A rounds, is that correct?
Previous companies.
How about, have you been through A rounds?
Us?
Yes.
Oh,
Few of them?
I mean, the company Greenwood.
Yeah.
I mean, raised 93. No.
No, we can take a pause there. I got the mic now.
Initially, but there's a
That's
deeper
fine.
story there.
That was the previous
Yeah.
release, that money they lost it all. So it's a long story. But we're raising money now, but I think that the point around where you're at or the stage of company you're at, there's a you effectively have to think about what is your capital story. And I do think one challenge or a trap that I easily get caught up in is I love to do pitches where I can tell people all that I know about banking. And that ain't a pitch. It should not be a pitch deck. Drop the word pitch, sales deck.
Mm-hmm.
Pitching to investors is selling. It is not sharing all that you know about the business, the product, the customers. You are selling something. 95% of what you think is important, they couldn't give two rats behinds about. So I think you have to be very particular about this is a selling activity, and who you're selling to matches the size or stage of company you're at, and understanding what is it that's going to get them to cut a check. And if you can pivot just for a minute to say to yourself, well, what would I have to believe if I was going to take either everything that I had in savings, sell everything I had, mortgage my children? What would I have to believe? I'm serious. What would I have to believe? And you get some real clarity on what should be in your pitch deck.
And to that point, so when an investor comes out and they're looking at potential opportunity to fund your company, they're typically looking to see if you'll achieve certain milestones. So you mentioned growth as being kind of one of those sorts of achievement markers. And so like, what are some milestones from like the earlier stages of your ventures when you're first going out to talk to investors that they felt very enthusiastic about?
Okay, I'll answer this quickly because a massive thing at the seed round that has nothing to do with fraction is it's you. When they cut him a check, 93% of that check was a bet on him. Same thing with you. These early rounds where any number you throw up, people are going to be like, seriously? It's so much about, do they believe that you have the staying power, have the vision, have enough discipline, have tempered excitement, will be honest and transparent with them, will quote unquote grind it out. They're assessing you as an investment. They may or may not be subject matter experts, but what they are is they're looking for the kinds of characteristics that they have seen in early stage founders whose companies have been successful. And so they're looking at that, and then they need to wrap it in some form of traction, or that shows that you are headed down the right path. But you know, if you're an investor or if you're an early stage founder, especially in that seed, pre-seed stage, man, the bet's on you.
Mm-hmm. Mm-hmm.
The bet's on you. Tell them and convince them why you are a good steward of their money. They may or may not actually even expect it back, but they want to know that you're going to be responsible and be as transparent and as and have an eye towards execution and learning. But like, don't underestimate. There's traction, but it's about you. Sell yourself. Make sure that they know who you are and the character you are. And you know, you will get more checks by being a really good person with a little bit of grit and a great idea. And a lot of people will place a bet on you. So
Yeah, that's 100%. I think another important thing, and you mentioned it when you went and were speaking to that investor that had that growth metric for you. You, when he initially said that your numbers were bullshit, didn't take that as something against your character. It was just crucial information that you needed to be able to make the right decisions. And I think that an important part for investors is that they want you to be coachable. They want you to acknowledge that you don't know everything or that they could possibly have something that can tell you of value. And it really energizes them and makes them more confident that you are going to be a good steward of their money because you're going to absorb the things that they've been able to teach you. And so, Chuks, when you've gone out to raise capital, what have been certain milestones or certain things that maybe you sweated? So we, at our last meeting, we had Robert Frederick, who issued a question from the audience, who was the technical co-founder of Amazon Web Services. And when his company got acquired by $20 million from Jeff Bezos, the mandate was that he'd put Amazon on all the Palm Pilot sort of things that we had back in that era, right? And so if he didn't do that within, I think it was like 7 months, like on the first device, then his team would get evenly distributed throughout Amazon and he'd never see them again except for at the lunch table or whatever. And so have you had any moments like that where you're like, can we do this? Can we do this thing with this thing that someone else is putting on me? Or any specific thing that even you've set for yourself where it's just like, how are we going to actually achieve that goal?
Yeah, I mean, I think so. Just like you said, right? There's like different types of milestones from either being early stage or like post, Series A, for instance, right? So my current company is, we're still very early, so there's still a lot of like figuring out a lot of things, market and all that, right? So I'll go back to the previous company because that's where I have a little bit more of a time experience, right? So when you go pitch for like a Series A, it's very different from like the earlier stages, right? When you're pitching for Series A raise, you are basically telling the investor what you are going to achieve. So in certain words, in certain ways, you are actually saying what those milestones will be. And that's what they're agreeing to. That's what both of you are agreeing to, right? If you're saying, we will, like in our case,
I'm sorry, can you explain what Series A is?
Okay, oh, sorry. So basically, it was in the previous slides, right? There's like, maybe you can put it up.
I'll go to it.
That could be helpful.
Oh, there it is. It's the second ladder here.
Right.
Second row.
Okay.
So when you start, basically when folks are starting out, you basically start with like, your money, family, friends, and, all that kind of stuff, right? And then you go into like this pre-seed and then you have a seed. It's just, different stages of funding. And each stage has a, different sets of requirements, right? When you're super early, it's kind of like, is there a market, right? Are you the right person to do this? Why you? Why now? Those sort of questions. By the time you get to like seed and Series A, by Series A, you actually have proven that there is a market, right? And the point then is like, how fast can you grow into that market, right? And how big is that market? How quickly is it growing, right? So those are milestones you would have to agree with your investor because that's what you're telling them, like, and we're gonna get to, this point in this amount of time. And the whole point there is, by that next, milestone, that's when you sort of start thinking of your next, well, not thinking, but basically you can go out again to go raise like the next, like a B, right? And most of them have like, revenue targets, like in our case, it was kind of like, how many, we had to like sign up patients on our platforms, right? So how fast are we signing up patients on our platform, right? How many folks, like when we started, we're at the seed stage, let's say we had X amount of patients on the platform using the platform. By the time we get to Series A, how many folks do we have on the platform, right? And how fast did we get there? Now at Series A, how fast can you get to that next, X thousand patients, right? Or practices, right? So it's basically the growth rate. That's something they're actually always looking for. And it also had like, revenue targets, right? But here's one thing that most folks don't really think about, right? Is also company building target, right? Because between pre-seed or like one guy, one girl or woman or whatever at the early stage and maybe seed or even Series A, that's when you actually start building a company, which means the machine has to be built, right? Talking sales, talking engineering, all of that stuff, right? It's like you have to build the machine, right? And that's a target as well. That's one thing most folks don't really think about, right? I didn't think about it because, before we got to Series A, it was just, I don't know, we're probably five people or so, just, winging it, for the most part. When we got to Series A, I mean, we raised about $50 million. Now we had the money in the bank, we had to actually now build a company, right? Which means, building, I mean, we started hiring like, VP of sales, like all these VPs, right? I'd never done that before, never, right? And those folks have to come in and build their org, right, under themselves, right? Which means they have to have a budget. All of those things have to be planned out. That's built in the company. And then what's the next thing? You had to actually have HR, right? I've never had an HR before, right? So all of those things are like part of the things that most founders don't think about at that early stage because you don't really need it, right? But speaking of, targets, those are some of the things that are part of the process as well. And it starts for the most part at the Series A stage.
And so I've got one more question. And so people that are in this audience or that are working from the Black Tech Night or the Tech at Night crowd are typically folks that are working kind of in the enterprise currently and perhaps are curious about the entrepreneurial space. And so I guess, what is your advice to someone that's in that position in terms of how they might proceed with the first step into entrepreneurship?
Right. This is the start, right? I would say, if you're curious, start talking to people, right? But one of the things I always advise folks would be just find something that you're just interested in yourself, right? Find something that you have passion for. If you have passion, doesn't matter what it is, right? Because here's one thing someone told me actually when I moved to Seattle for the first time and I did my first company, right? I had so much, if you had met me, Phil, I mean, I still have passion, but if you had met me like 14 years ago, I came to Seattle, I didn't know anybody here, but I met a guy here and I pitched him this like great idea, right? What I thought was a great idea. And I had so much passion in that pitch. And he looked at me, he was like, you know what, Chuks? I see your passion. I don't see what you're trying to do. It's probably gonna fail. But I tell you what though, you're gonna learn so much, right? That the next thing you do might actually succeed. And I looked at him, I'm like, like he told me, I met him, I saw him making like a few weeks ago. I was like, remember what you told me? Right? He was right. He was right. So here's the thing. If you're like out there in some company or whatever and trying to figure it out, don't even think about if this thing will succeed or not, right? What you're trying to tell yourself is, do I have what it takes to go out there, right? And build something that solves someone's problem? You might fail. And in all reality, you might actually fail, right? That thing might actually fail, but you will learn so much that you can take all of that experience you've gotten from that experience and move on to the next thing, right? So most folks get fixated about trying to quote unquote make it that first time. It might not happen that way, right? So I'd always say use it as a stepping stone, right? Just go out there and do something. Yeah, that's the only advice I give folks, right? Like, don't wait, just go out there, try something and see where it takes you, right? But the most important thing is, find what your passion is and just go out and do it, right? Go out and do it.
Does anybody else
Can
want
I
to
add to this?
Yes,
Yeah,
sir.
'cause this is a good one. And I'm very optimistic with answers, but I want to have this real statement that I've seen recently, and it's something that I wish I'd have heard this way early. Everyone will expect you to hold a mirror to yourself while they're holding the sword at you when it comes to your idea. And it's gonna seem, I really want you to hear what I'm telling you. They're gonna be expecting you to be the perfect version, what your app is, your app shining while holding the sword at it. I had so many people tell me this was a horrible idea when I first started. Horrible, crappy idea, never do it. And like I said, when I first started this, I was kind of believing that. And then there's an app out right now for just pickleball. It's called Pickleheads. It's the same app idea. He's a man from Google. I think his first raise probably is around $2 million. Same idea for just pickleball. And I was thinking about that like, man, I shouldn't have listened. I should have believed in myself. And I would say, as long as you can get that out your way, you're gonna have a lot of naysayers, a lot of people who may have good intentions, because a lot of people do. Not a lot of people are malice. They just are trying to put information in your head to say, hey, slow down on this passion, right? Let's think about it. And that's the truth. But sometimes you have to separate that and go, do I have enough passion to do this, right? Do I have enough drive and grit? Because it's going to take drive and grit. And then I would say after that, it's about the stepping stones. Like I think a lot of people say there are some tried and true stepping stones, like surveying people, building prototypes, raising a family friends round, because that shows that you have backing from your own friends and family, even if it's not a lot of money. It shows that people actually believe in it. Getting people on the wait list even before all of that. There are some true things you can do to really build that. And I would say, if you're interested, learn from a founder, learn from one of these people who have done it. And you don't need to follow it 100%, but these are kind of like the building blocks to doing it correctly and building more success.
Thank you.
I'll add one last thing that I think, I get several founders who go like, I have an idea. And I will say, so effing what? The issue is not the idea. The issue is, why would anyone give a damn? And you better be clear on the problem that you're solving. An idea is not necessarily a problem to be solved, or that is solvable, or that could be an interesting business. I would just tell people, I agree 100%. You got to just start, talk to people. But when you're having conversations about or stress testing your quote unquote idea, ask yourself a very simple question. Why would somebody care if I solve this problem? How many people would actually care if I solve this problem really, really well? What are the barriers to me actually solving this particular problem? That's an idea. An idea, verbalizing or rhetorical language around a problem is not the right first step. The right first step is to say, great, the problem, world hunger is a problem. Okay, what is your idea to solve the problem? Why would people care if you solved the problem? And are there a lot of them? You can ask yourself that question at 2 a.m, staring at the ceiling. But just be sure to ask yourself that question. There's a lot of entrepreneurs who decide to quit their jobs, or are burning the candle at both ends, and they haven't even really answered the questions to themselves. Yeah. Why do people care? They just start, I'm gonna start coding, blah, blah, blah. Great, now we have another app in the world. Like who needs that? Yeah. So I think that is a really, really important thing to ideate on. The last thing I will say is, as you think about your funding in your company, I kind of think of it in the framework of, there is the percolation, which is I'm ideating, seed, pre-seed. There's the speculation, which is kind of seed, quasi headed into Series A. Then there is, actual, execution, or stated another way, extrapolation, which is I can look at previous numbers, operating history, and I can extrapolate. I'm not speculating on a forecast. I'm not percolating on a forecast, but I can extrapolate from a set of operating history metrics that prove positive that I'm going to get this much money back by the company executing at this level with that kind of valuation over some period of time. So just think of your kind of business in those phases, and just be clear on who your investors are and what they're looking for at that particular moment or during those phases, and you'll be better off than I was the first time around.
Yeah, that's great. Thank you so much. Applause for the panel, please. And so I'll go ahead and pass my mic around for people that want to ask questions. And then I just wanted to double tap on that too. I mean, the power of storytelling. So first, you've got to make sure that you care. And then, because you'll then have to talk to investors, and the fundamental law of storytelling is make me care. So if you can't make them care, because you don't know if you care or not, then you're gonna have some problems.
Question.
Thank you so much. This was really a wonderful conversation. I have 2 questions. Chuks, you mentioned that the guy said, I have no idea if this is going to succeed or whatever, but you'll learn a lot even if you fail. Did that person invest?
No, 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 we did not. Funny though, I wasn't actually pitching for an investment back then. I was new in Seattle, so one of the things I never talked about was before I moved to Seattle, I moved here from Dallas. I was trying to come here. I didn't know anybody. I went online and literally searched who to meet in Seattle. Right, his name was one of the first, first name that popped up. Right, I sent him a LinkedIn message and I said, "Hey, newbie in Seattle, I want to come up here." And I came out here and I met him. Bob Crimmins, if you know him, right? He's guy. So I've talked about his story, so he knows. Anyway, so I came up here and I said, "Hey, want to have coffee with me?" And he said yes. So we met for coffee, and I told him of what I was working on, what I'd love to work on, because I wasn't working on it yet. And yeah, he was the one who told me, great guy if you know him. He told me this stuff might not work out, but I should keep up, right? And I did.
And he's still part of your network and
Yeah,
all
great
that.
guy.
Yeah, fantastic. Eventually, he probably will. And then my second question is, Dave, you mentioned the board. And so I'm really interested to know from all of you how you have addressed having a board. When do you think founders should really think about having, a formal board? Because if you do that too early, you're, giving up potentially more equity than you need to. But also the other thing is, I've heard stories of founders getting booted out of their companies over disputes with the boards and really disputes, not necessarily because the founder is incompetent. So I'd love for you all to comment on that.
Yeah, really good question. I mean, we'll go back to, I don't know, the percolation, speculation, extrapolation. I really think that in the seed, pre-seed, those early days, you do not need a board. You need a couple of advisors or a collection of people that you can bounce ideas off of, but it's unnecessary, and it's overkill to think that you need a board. I think, frankly, until you have probably Series A, if you do end up with a board, it would most likely be the result of you asking somebody to be a board member because it lends credibility to the company, or somebody's cut you a check and they have said, I think I want to be on the board. And the minute you start to head down that territory, there's a real bifurcation between getting advice and board governance and fiduciary responsibilities and voting rights and all of those things. So the minute you head into, establishing a board of directors, you have now kicked off a bunch of paperwork. You now have a fiduciary responsibility, depending on your D&O insurance and how the bylaws are constructed. That board member is on the hook, just like you as a CEO, if there is, fraud at the company. You also need to think, and your question around being voted off, how many people are on the board? The worst position you could be in is having 4 people on the board. So if you're gonna go down the board path, then that sometimes is forced by an investor, you either go to 3 or 5. Do not have 2 people board or 2 people on the board. Do not have 4 people on the board because it's a tie, depending on how your bylaws are structured. And I think you also want to be very careful about voting blocks and super voting blocks and all of those things that prevent. What you want to figure out is a governance structure that is flexible, but it also is, you as a CEO, you shouldn't be afraid of it, because if you get the right board people, you will be a better CEO. They can help you, but you got to get the right people, and you got to make sure that you don't do it too early. And I can certainly tell you one of the big mistakes I made in my very first company, I paid too much attention to the board. I should have been paying more attention to customers and employees and all the things. I became a little too starry-eyed around who was on my board, and I spent more time listening to them and hearing their feedback. They weren't the frickin' expert on our customers. They're not in the trenches. And so, just be careful about when and how much. If I had my wishes, I would have advisors all the way through. And only until you raised a tremendous amount of money, Series B, or Series A to B, to bring on an actual official board. And that's when I think you get the benefit, because once you get out of ideation and into extrapolation, that's where I think boards can be really, really helpful.
I would like to add to this, yeah. If you're even like pre-seed, I hate absolutes, but if you're pre-seed or family, you shouldn't have a board. I agree with this, and this is some of the feedback I got, even from like some of the early investors we had and friends. I think even talking to you is one of the things that we like don't have it too early. Now it's not an absolute there. I think there are some times where you're growing rapidly, things are going crazy, maybe, but it's going to be rare that that's needed. We actually have had a couple people who've offered board seats. Actually, last week, I think we had somebody who's like, I'll invest a certain amount of money, I want a board seat. And it was an instant no, because it does give up a lot of power. And this is not my knowledge base. I'm a software developer, right? My partner knows more about this space, but just from what I know, the horror stories I've heard, and my lack of knowledge, this key on this one, no board seats at this point. Not until we know we need one. So that's all I have to say on that one.
Yeah, the only thing I'm gonna add, and really agree with y'all. One thing I'm gonna add is something founders sometimes don't understand is at the earliest stage, you know, that's the point at which you're trying to build something, right? You do have leverage. And you actually want to keep that leverage as far out as possible, right? Because that's the one thing that kind of gets you going. So if you're super early and let's say you're going out at the, family or friends or pre-seed round, and you actually have an investor demanding a board seat, you really need to look closely into that investor, right? Because here's one thing most folks don't understand, right? Not all investment is right for you. Right, it's kind of like
you should say that again, just so everybody in the room hears that.
Not all investment is right for you. Don't care how much money it is, right? There is something called bad money, right? And trust me, you don't want to be in that situation. There is something called the right time to go raise, and there's also the wrong time to go raise, right? And that comes with, trying to sort of get in bed with the right investors. Right. It's like in everything else, right? Your co-founder, right? Your partners, your investors, right? Everything has to be aligned. And if they're not aligned, it's going to cost you more headache than is worth it, in my opinion. So,
kind of connected to that. Could you talk a little bit about I guess, the intersection between your personal finance and maybe like your personal financial readiness to kind of go into this space? And is that like kind of a thing to consider? Like I would imagine if you're like I know that there's like a family and friends round, and then there's like kind of like a lot of folks are just doing it for bootstrapping and doing it themselves. Where do you begin to like actually start thinking about that part? Like how you're going to start funding it from yourself versus looking for investors and kind of putting that on them? Because I would imagine there is a level of personal investment, time and labor and intellectual property, but also probably like finances. And then that gets into,
Yeah, I mean, I think I know what you're saying, but honestly, I don't think there's a one size fits all, really, right? Because I've met founders who have, who basically just had, ton of personal wealth and they just went at it forever, right? I've also met, just super broke founders as well, right? And I've met folks in between as well, right? So, and quite honestly, I've been on all the ends of that spectrum at one point or the other. But there is not a one size fits all. Right. I think it also has to do with your personal situation. I'll talk about things from my perspective, right? Before I go start, so one of the things I will start out by saying is, I'm just consider myself super blessed to have a great network of just, family and friends, really close folks, right, who actually support me. Before I actually start a company, I tend to call, sort of a get together. Like, hey, I'm gonna start this thing. I know it's gonna be hard. You might not see me for a while. Like, do I have your support? Because quite honestly, if I don't have the support of the people around me, I'm married. I've got a great spouse. I don't do it. Right? To me, it's not worth it. Right? Because there's gonna be times where you would have to look at your partner in the eyes and tell them, I know I said this 6 months ago.
That'll be a year now.
2 years later, I'm saying, a year, 2 years. It's gonna come, right? If you don't have that support, it's gonna make things extremely difficult, right? So in terms of preparedness, you need to start from that perspective, right? Like everyone's situation is different, so start from where you are, right? And sort of work from there.
I just want to tap on the board thing. Don't fold into a check. You can say board observer, seat maybe.
Love to talk about Alex. I'm sure I can learn a lot from you. This is the thing we're in right now. It's
gotta be the right, I mean, depending on where you're at, you just gotta make sure that like, they're, depending on the stage, depending on how well I think you know the person who's coming or persons that are coming on the board, you may have very, very different opinions on, what is a vibe, what does a good exit look like? How long are we gonna stick with it? What is the burn, and do we think the burn makes sense for where we're at? You even have to think about their kind of intellectual agility if you want to pivot, and you don't want to be hamstrung by trying to convince a board member. When you're iterating, you see a signal that has you tacking over here. You don't want to have to go necessarily, okay, I have a 3-hour board meeting to talk about whether or not we need to pivot. Like, you just need to move. And so I think this is where I think you should start to separate it between governance and help. And the minute you start moving into board members, etc., you're moving into a governance structure that has a whole new. It has its own.
That'll be a series day. In my opinion.
100%.
You gotta show that.
Here's the question though. I almost want to ask you some questions to this, because let's say you're cash zero now,
Yes.
and someone goes 500K,
Yes.
board seat. What do you
Yeah.
say?
It's not
Change
black.
the answer.
No, it is, because it's not black and white. I think it
Yeah.
would be, how long have you known this person? What credibility do they have in the industry? Is their name associated or on the marquee? Is it 500K plus then a halo of having them involved? Are they able to? And then what I think you do is, I mean, if you get kind of a check of like, okay, I may not have grown up next door to them for, the last 35 years, but it feels good. They seem to be engaged. It's going to cash flow my company, and I can leverage them for additional dollars in the door. So what I'm going to do is I'm going to make it an 18-month or 24-month board term.
Yeah.
Or at the next financing opportunity or above a certain level, I'm going to restructure the board. That person gets their day in the sun. I get what I need to keep my company going, but that also gives me an opportunity to see over time. If I want to keep them, I keep them. If I don't, they flip after 2 years. But here's what I wouldn't do. I wouldn't be so arrogant to say F off, pound to sand, and close shop.
Yeah.
I mean, I'd have to seriously consider it.
Yeah, what is intent, right? What are their motives for this? Is it just you want document rights? Is it just that you want me to check in with you predictably at a point? We talked about it.
Correct.
But yeah, this was great. I think we're close for time. We're over on time. But, yeah.
What? Can we do one more question?
Thank you all for being here this morning. Is it on? Can I hear me?
Yeah.
Do I? Okay. Oh, okay. My question is, as someone who's trying to start something, recognize a need, that you want to build something for, is software. As you look at the spectrum across Seattle and right on the stage, all 4 of you have software background. So it's, in a way, it's kind of easy to go in the backyard and just build, and then show something to attract other people. What are your advice for people, someone that doesn't have a technical background, that wants to build a technical product?
Well, here's the good news. I'm not an engineer. These guys are.
Okay.
I am not. So My trick up my sleeve is I leveraged my oldest daughter at one point. And I have a lot of friends who have been great over the years who can crank out prototypes now. With some of the new AI, no code tools, I probably just jam out a prototype on my own at this point and see what kind of signal I could get. And then figure out, okay, if the signal looks positive, what's now the most efficient way for me to now potentially get this built? Either different architecture, et cetera, but like, you can crank out some pretty impressive no code apps right now that would get you, I think, pretty far down the path as far as like signal from customers.
Last night alone, I was like, I had an idea for something, and I was like, there's a site called, I'll just give you the answer. It's like V0, Dev0 is it? It's I think it's Dev0. And I was like, hey, can you build V0? That's it. I was like, can you build a leak management tool that does this particular thing? It did it in 5 minutes. So yeah, I needed to make changes to it.
V0.
V as in vacuum.
Yeah, V0. Yeah. So I would encourage everyone, regardless of where you are, one or two things: prototype first. Prototype first. You're gonna waste money before you even talk to customers or before you show this. Speaking from me, if you build first, prototype. And what we mean by prototype, just so what you know, it's like a design of like, here's what this screen will look like. Here's what this will look like. Sometimes it's working. Sometimes you can click buttons and it goes to different pages, right? But it gives your users, your investors, people, your friends, and let's just say that an idea how this will work when it's built, because there are going to be pitfalls. I have the luxury of being a coder, so I can build and go, this doesn't work. But some of you who don't have that background, if you build, you're going to be spending a lot of money to have somebody rebuild it. So the second thing I would say for this is network with people. There are a lot of people like me who would love to help people, especially people of color, people with underrepresented backgrounds, help build their product, right? And some of the ideas, you just need a wireframe build so you can go build it. So if that's something you're interested in, for sure, talk to me after, and I will do what I can to help you.
I'm gonna add one thing on that we actually have some great universities around in the Puget Sound area. I put up flyers. I mean, I'm old, so this is back in the pre-AI day, but like, I put up flyers at UW, Seattle U, Bellevue, et cetera, and I had tons of students that were interested in interning for the summer or working on a project. And even if they didn't get credit for it, they just wanted to be a part of something. Yeah. So it was effectively, it was somewhat, I guess, cyclical or seasonal, but hit universities. Yeah. I mean, there's a lot of, even high schools now. I mean, there's a lot of incredibly talented developers at the university, undergrad, that would love some experience and just the opportunity to say, I worked on something that could be something, is fantastic. And they also, you can hire them very inexpensively if they want to do some moonlighting. They're going to be a lot less expensive than an engineer full-time, certainly, or even moonlighting here if they're working at Google, and it's going to be a lot easier to manage than trying to do something offshore. So,
are there some interns in the house right now? There you go.
There you go.
There you go. Fantastic.
See, I mean, there you go. That's it.
Yeah, and you can hit me up too. We work with Computing for All, and they're always looking for opportunities like that.
And my son who just had to leave to catch a flight to go back.
Okay, I'm in the right room.
Yeah. Nice. So I'm just gonna add one more thing. Totally agree with everything everyone has said. Here's one thing I tell folks now, right? Especially folks who are not technical. See, I went to school and I spent 4 years, to get a computer science degree, right? That was all great, but here's what you don't need right now. You don't need that right now to go do what he just talked about, right? So I've got like a 3-step process, and I was just talking to my niece just yesterday. She pitched me an idea, and I'm like, here's how you build it, right? And we're gonna build it. She's literally gonna launch it tomorrow, right? So here's what you do, right? Go to ChatGPT, right? The new programming language is called English, okay? It's no longer C++ or Java or whatever. The new programming language is called English. If you speak that language, you can build anything today. right? So here's a challenge I'll give you. Go to ChatGPT, or if you like, my favorite is what's it? Claude. So Claude, CLAUDE.ai, right? Okay, you go there. Again, if you can't speak English, right? Describe what you're trying to build, and tell it to create what's called a PRD document. That's a product requirement document. That's basically an embodiment of what you're trying to build, right? In the doc. Just say, hey, describe, just whatever. Just doesn't matter what it is, right? Just describe it and say, hey, write me a PRD document, right? It's gonna get you that. Now use that as your framework. You take that document, put it in a PDF file, and then go to this, my favorite right now to start for non-technical people is called Lovable. Okay, so go to Lovable, LOVABLE.dev. Okay, upload that document and tell Lovable to build a minimal version of that product. And watch it do it in 5 minutes. There's a button to the top right on Lovable called, and here's a third step. Here's a third step. There's a button on Lovable called Launch. Right? Once it's done, you click on that button and it launches your product. That's 3 steps you can do in 5 minutes. And then of course you can iterate. Yeah.
It's unbelievable.
Yeah.
Unbelievable.
So again, as long as you can speak English, right, you need to describe it in English, because I think most of it just works in English right now, I believe. Yeah. So as long as you can describe what you're trying to do, and it doesn't have to be, does not have to be fleshed out, just raw, right? Just raw, describe to what you're trying to do, tell it to write you a PRD document, take that document, save it as a PDF file, and then upload that document to like a Lovable. You can use V0 as well, right? But I just prefer Lovable, right? And once it's done, you like it, click on launch. It's live. 3 step.
All right. Yes.
And then you can call yourself a founder.
Let's give the panel a round of applause. Thank y'all so much for coming and spending a big chunk of your Memorial Day Saturday with us. This was an amazing panel. Thank you guys so much for sharing your expertise with us. We will be having another one of these June 7th. It'll be at the WOW Gallery. And this is a series that we're going to be continuing also. We're going to have a lot of great folks, and we'll have like some more things for you guys to like take with you to continue this, thinking. Tell a friend and tell a friend. A few other events. We have our next Tech at Night. It's actually going to be in Spokane. If you know anyone in the tech ecosphere there, yes, I know you do. We need to connect. It's going to be June 17th. And then we have our next one in Seattle will be in September with Remitly at their new headquarters, which is somewhere down here. And that's going to be a really great one too. And yeah, we'll make sure that you guys are connected. This was recorded, so we'll send this out to y'all too. And yeah, have a great Memorial Day weekend. Thank y'all very much.
Good job.
Good job.
Good job, man. Good job.
Yeah.
Thank you.
Of course.
This is awesome.
Ben, were you did you say you were at admin by any chance?
No.
Like, I heard you mention website.
No, I was at AWS. I was like,
I heard you mention website.
no, I ran the